your income statement first. Must be prepared before your balance sheet, because whatever net income you get goes into the owner's equity in the balance sheet side.
Is it as retained profits or?
No. As retained earnings, no, it comes as net income.
Okay.
So whatever you own, so if the balance sheet doesn't balance, there might be an error in the income statement. So the net income goes straight into your owner's equity over a period of time, and it can be into retained earnings as well. And the income increases in the owner's equities claims against the assets. But then again, do you think income is a cash asset?
Well, cash is an asset in itself, and income is income.
Yep, so income, exactly right. Income is not a cash asset. Income is not, so it's not. It only becomes part of owner's equity, but it's got nothing to do with asset. Or it's nothing to do with what they own. So it's through the income equity accounts so it's through the income, the earnings of the business, that's a link between the balance sheet and the income statement, what the business earns. So it gives you a picture of the total financial picture of the entity with the earnings from the income statement and the balance sheet. So that's why you always prepare the income statement first, because whatever income that you earn from that reflects back into the balance sheet under owner's equity. Again, and usually if net income increases, then generally your equity will increase as well. The opposite is if you have a net loss, then your equity will decrease because you're getting less share for the shareholders. And again, just the importance of reporting is so the shareholders can invest in a company to show how viable the company is. And that's why we do these reports, the income statement and the balance sheet, so if they want to invest, to make it healthy. And obviously profit maximization. And it's also a good way to, as a budgeting or benchmarking comparing it for 1 year to another, to compare how well your business is going from the start to the end. You can think, okay, this year we had this much profit, but last year we had more. Why? You can see what you're spending on budgeting. You can change what you're spending. Do we need that? Do we need to spend this? Do we need to spend that? Trying to minimize expenses. If the organization's goal is for profit maximization, then you need to decrease your expenses, and you need to see whether there are expenses that you don't need. Whether you can think, do we really need these expenses? So it could be used as a benchmark, and you can see where your income is coming from. How can you expand the company? These are all useful reasons why we have reports in the first place. And also, again, if your revenue increases, your income increases, and generally your assets increase because you receive cash, and consumers pay you by cash, or they can pay you by accounts receivable, but that also increases your assets through the revenue that you've been received by the consumers, and overall this will increase your equity. If your expenses increase, then obviously your assets will decrease, such as your cash, because you need to pay your expenses from your cash. And also this will increase liabilities, such as accounts payable, because you're obviously, buying from your suppliers, or you need the money from the bank, and this will also decrease your equity. So it's sort of like they have inverse relationships between them. So can you tell me a bit about what the account relationships are, Pamela?
What do you mean, like?
For example, what's their relationship within the accounts itself, like the relationship between equity and liabilities or assets?
The relationship between them all.
Yeah.
It's just the accounting equation. The assets less liabilities equals owns equity. That would be the relationship between them.
Yep. So, if assets increase, then what would that mean to the liabilities and equity?
Well, you hope that if the assets increase, then so the owner's equity increase, and vice versa, as the liabilities go down, therefore the owner's equity will also increase.
If the liabilities what?
Go down, the owner's equity will increase. Because you
have... So if you have less liabilities, your owner's equity will increase as well.
Yes, that's
what you meant. Okay, awesome.
Yes.
Okay, that's good. So now we come down to the verbal questioning. We did a bit of questioning, but we've still got a bit of questioning to go. So again, just briefly, what is assets, liabilities, and equity in your own words?
Assets is what the company owns, and liabilities are all the loans and debts that the company has, and the owner's equity is whatever the shareholders have at the end.
Okay, good. So depreciation. Depreciation is basically dealing with your plant and equipment and your motor vehicles. It means that every year they decrease in value, and that means you have to take it out of your non-current assets because it's decreasing every year.
A decrease in value.
Yes,
that's right.
Which it can become your depreciation.
Would then depreciation become an expense in the income statement revenue?
Yes,
for
it becomes an expense because it lessens your assets, and it does become an expense because you have to pay for that because it's a reduction in your assets. So you do it in both ways. You have to reduce your non-current assets, so you have to minus it from that, and it will go into your income statement as a depreciation expense. What about retained earnings? Do you have any knowledge of that?
I thought that's part of the earnings equity, where under
income statement, yeah, it goes into that under retained earnings and also any other earnings that you have retained throughout the year.
Yeah, in the balance sheet.
Yeah, in the balance sheet, you name it as retained earnings.
Yeah, so not the income statement.
No. Retained earnings goes into the balance sheet, not income statement. So the income is your income statement, and your retained earnings is within the balance sheet under your owner's equity.
That's exactly right.
And it's the profits that you've accumulated.
Yeah, that's right. That's how my understanding is.
Okay, so again, what's an example of the relationship between the accounts? We just wanted one particular example.
Between what accounts?
The accounts that we looked at, which is your assets, your revenue, income, expenses.
Oh, the relationship between them.
Give an example.
Well, if your sales exceed income, it becomes like a net profit, a net loss, or a net surplus. So if your revenue goes up, therefore your profit goes up. If your expenses go down, so will your profit go up. Yeah, that sort of thing.
So what is the earnings? So when your retained earnings appear in the balance sheet, what does that represent?
Is it an accumulation of your profit or loss from previous years, or is it just the current year?
The current year from the income statement. So it represents the income, or so it represents the surplus of the income from the income statement that appears into your balance sheet. Okay, so that's what it represents.
It's not the prior years as well.
Retained earnings, yeah, it's for prior years. That's why it's called retained.
But
in this particular session, we're only dealing with this year, but it is prior retained. That's why it's called retained. So it's not just earnings from this year, but it's also retained earnings from your previous years to return to that. But in this particular, I'm asking what earnings represent in the balance sheet. I didn't ask retained earnings. I asked what the earnings were. Earnings is your income from your income statement. But retained earnings, you're right by saying that retained earnings is from other years.
Yeah. So I wasn't sure about that clarification.
That was right. Thank you. Okay. So what does it mean by an increase in equity of a company?
Increase in equity of the company, well, that will be reflected between the assets and liabilities again. Either the assets increase or the liabilities decrease. Therefore, the owner's equity will have to increase at that point.
Okay, good. Give us some examples of liabilities.
Okay. I think there's current liabilities and non-current liabilities. So, current liabilities are short-term debts less than 12 months. So that would be accounts payable, and short-term debts like bank overdrafts. Non-current liabilities are over 12 months. So that would be like mortgages, over plant and equipment, and that's over 12 months term.
Okay, good. What about equity?
Owner's equity?
Yeah.
What is it?
Yeah, what is owner's equity? And what an example of owner's equity
owner's equity adds up all the retained profits and earnings from the income statement, and it's the accounting equation, which is the assets less the liabilities equals owner's equity. So that will be the difference, what's left over.
Okay, good. So how is net income, calculated, do you think?
As you said, it was it was income less expenses.
Yep, so income and revenue, that's good. Okay,